You're all very welcome this morning on this cold Belfast morning to the Merchant for the CBRE Outlook presentation on the commercial real estate market. As I was going through the agenda here, basically I'll be doing just a quick introduction and then handing over to Marie. Marie heads up our research department, and she'll be going through the different sectors, including the European market at the moment, how that's affecting us, the Northern Ireland market, the different sectors, office, retail, industrial, investment, hotels, and then development land, and then a summary. At the end, we will leave a couple of minutes for questions as well. Since we came and met here last year, CBRE have grown worldwide by about 25-30%, and Belfast has replicated that, now up to 30 in the Belfast office, and covering all sectors of the market. A couple of the departments that have increased this year include building consultancy, professional services, and management. We've taken on 4 or 5 people, so we're growing. And I think at the start of last year we said we were hopeful that it would be a much better year. I think it did become a much better year, but it happened in the last 6 months rather than all the way through the year gradually. One of the themes that I'll run through today is technology and the advancement of technology and globalization. And you'll see we're videoing here today. That's sort of because technology means that we can now put this onto Google, we can put it onto LinkedIn, etc. We can promote ourselves through it. So it's very important. It's also very important Northern Ireland sells itself through this technology into a global market.
We're here today to launch what is our 25th edition of our Outlook document, so specifically for Northern Ireland, and you've got one to take away with all of the facts and figures in it. But I suppose to set the scene, I thought it was important to give you a little bit of a run through what's going on at a European level, because the trends that we see in the real estate market in Europe really reflect what's going on in many sub-markets. And I suppose starting with economic outlook, this was what we all thought the world was going to look like 12 months ago. So when we stood here last January, we were expecting somewhere between 1 and 2% GDP growth or GVA growth in Northern Ireland. And obviously there was less growth anticipated in the Republic. And looking right across the rest of Europe, you can see lots of reds and oranges there in terms of lacklustre growth. Now, we've only moved on 12 months, but the world has really changed, and most economies now have a better economic outlook than they would have had even 6 months ago, because the second half of last year saw a massive rebound. And in fact, Northern Ireland and the Republic now expecting in excess of 2% growth this year. And I suppose the significance of that is once you have a recovery in economic conditions, it, in general terms, feeds into property performance. So we can expect a better property performance on the back of stronger economic growth. And I suppose what is particularly significant about this is the red has all but disappeared. There's a few countries like Italy and the Netherlands, for some reason, where not very exciting growth is anticipated in the year ahead. But most countries have seen an improvement year on year. And as I said, as economic conditions improve, it's good for all of us. Looking at commercial real estate spend, I think what we're looking at here is over the last number of years on a European basis, the volume of investment spend has increased to the extent that last year we saw 154 billion being spent in the European commercial real estate market, a full 21% uplift on the previous year. So the uplift that we're seeing in economic performance and indeed investment spend is happening at a much bigger scale than we're seeing even in our own market. Another thing that's quite important is back at the peak of the market, and I suppose every market peaked at a slightly different time, but somewhere between 2006 and 2007, when all of the markets were performing quite well, there was a very significant proportion of that investment that comprised debt. So, for example, in 2007, about 70% of all of the investment spend was debt. Arguably in the Republic of Ireland, it was probably 85-90%, and probably a similar scale in Northern Ireland. And I suppose one key difference that we've seen over the last couple of years is that the volume of equity has started to increase significantly. And in fact, at a European level last year, only about 30% of the spend comprised debt. So that in itself is good, because it means we're better insulated this time round. We're not as wholly reliant on debt. Now, over the last 12 months, there has been a significant change, and obviously many of the countries, such as the Republic of Ireland, Portugal, Spain, Italy, which had a torrid time over the last number of years, saw a very significant turnaround in performance in terms of investment spend, because lots of international investors in particular flowed into these markets because they could see the extent to which values had fallen, they could see the extent of deleveraging that had to happen, and they saw opportunity. So, for example, places like Spain, Italy, Portugal saw a doubling of investment spend year on year. Now, I know we're here to hear about Northern Ireland this morning, but I just wanted to give you the figures for the Republic, just so you can see in context, when you strip out the Italys and Portugals, exactly what happened. We went from a situation where there were only 13 investment deals over €1 million in value completed in 2009 to 96 in the last calendar year, 1.78 billion of spend. On top of that, we had another 750 million of loan sales, so total liquidity of over 2.5 billion, a remarkable turnaround in 12-month period. And I think when we move on later to look at the Northern Ireland figures, you'll see that a similar trend is starting to happen here as well. Arguably, Northern Ireland is behind the curve in terms of deleveraging, but arguably what happens in one market will ultimately happen here as well. I'm just going to put up some statements. I'm not going to read them out, but I just want you to consider them. This is talking about an upsurge in transactional activity in the market. This is looking at the fact that international investors are looking at investing here. Third one is talking about a general improvement in the economy, as I mentioned at the outset, and how that feeds into property performance. These three statements actually came from our first Outlook document in 1989, not from anything we've written recently. So what that clearly shows us is property is cyclical, and we go through peaks and troughs, and we get down to the bottom. It's hard to see the top. When we're at the top, it's hard to see the bottom, but it follows a cyclical pattern. And I've just pulled out one other statement from that 1989 report making that very point, that property is cyclical, and as sure as night follows day, the cycle perpetuates itself. Brian mentioned the word technology, and he mentioned the word globalisation. What we've done here is just shown you some words that we use every day now. They certainly weren't in use in 1989. 25 years ago, things like social media just didn't exist, and yet these are the things that are influencing the market today. We're moving more and more towards hot desking, remote working. That's in terms of the office market. From a retail point of view, we're buying lots of stuff online. From a logistics point of view, those goods have to be shipped and delivered to us. So whether we like it or not, globalisation and technological change are having an impact on the real estate world, and they will shape how much office stock, retail stock, industrial stock we're going to need in the future, how we design those buildings, how we occupy those buildings. So of all of the words on this particular slide, I would say globalisation and technological change are the ones that are going to shape the next real estate cycle. Moving on just to talk specifically about the Northern Ireland market, and we'll start with the office market. What we're tracking here is take-up or letting activity in the Belfast market on a quarterly basis. And what you can see there is 2013 was a strong year. Now, arguably, you didn't have any big hit FDI announcement. There was some FDI that came in over the course of 2013. It would have been a lot stronger if we had a resolution on the corporate tax structure, I would think. But even in the absence of a large, major FDI announcement, you had take-up of over 400,000 square feet, which was up 47% on the previous year. Now, arguably, it was skewed by one or two big transactions that happened during the course of the year. But even with those stripped out, there were over 56 lettings signed in the Belfast market in the last 12-month period, with quarter 2 and quarter 4 being particularly strong. We break them down into the types of companies that are taking space. And I suppose had we done this 25 years ago, even 10 years ago, the public sector would have been the most dominant taker of space in Belfast and in Northern Ireland generally. And 36% in 2013, it still was high, but I would argue that that was skewed by a couple of the big deals that happened, like the letting of almost 100,000 square feet to Land and Property Services down at Lanyon Plaza. That one deal alone skews those results. And if you strip that out, what you see is the take-up is quite well balanced. And that's good because you don't want a sector that's overly reliant on business services, overly reliant on IT. If there's a crash in those sectors, you're very exposed. So stripping the public sector out, the take-up in the office sector is quite balanced, and that's what we want to see. And I suppose going forward, in the absence of major public sector lettings, you're going to see the public sector being a less dominant force in Belfast. There's a lot of discussion over the last few years about the scarcity of Grade A accommodation, and indeed it's an argument in many markets, including Dublin, and it has been an issue for Belfast for quite some time. And if we look at even the space that was signed in 2013, you can see that the vast majority of it was in Grade A buildings. What that has meant is that we're slowly eating into the supply all of the time, and the quality of what's actually vacant and available to let is deteriorating, so the vacancy rates are getting lower, and that in turn is going to put pressure on rents. We haven't seen office rents in Northern Ireland increasing for years, but we're building in an uplift in 2014 simply on the scarcity of Grade A accommodation. You have some schemes that are now on site and starting off and going through the planning process, but they're not going to realistically be delivered for some time yet. Just to summarise our expectations for this sector in the year ahead, I think it's fair to say that we're likely to have a healthy volume of take-up again. We're aware of many requirements that are out there, but as we said at the outset, in the absence of having a firm decision on corporate tax, you're probably not going to land a big ticket FDI announcement until there's a clear decision on that. But even in the absence of that, you would expect to see quite a bit of take-up. I think the likelihood is that the demand is going to come from existing occupiers who are getting a little bit more confident now that economic conditions are improving and are looking to expand and relocate. You will have some new entrants, but I think the reality is that most of those will be quite small in nature. In fact, of the 56 lettings that happened in Belfast last year, about 35 of them were less than 5,000 square feet. So lots of small lettings will be the order of the day. There are some new schemes being developed, and obviously City Key 1 is the first new office scheme that's under development in about 6 years. You have City Key 2 now gone in for planning, Weaver's Court under construction. There will be others as the year goes on, but until such time as they're actually finished out and ready for occupation, there are going to be continued shortages of Grade A accommodation, and that in turn is going to lead to more discussion about the refurbishment of older buildings. And it's not like you can suddenly decide to start refurbishing every building. It has to be done on a case-by-case basis. In some cases, the maths will work and it will make sense to refurbish an older building. In other cases, the building might be too old or not compliant with health and safety or other legislation, and it may not be feasible. But there will be a lot more discussion about it, and I think aided by the Business Premises Renovation Allowance, there's no doubt but that we'll see more refurbishment projects being started. We are predicting a very significant jump in prime headline office rents, and in fact we have done a few deals in recent months that are probably not too far off this level. So going from about £12.50 per square foot to £15 per square foot over the course of the next 12 months, and that uplift in prime headline rents is purely driven by the fact that there's a shortage of Grade A accommodation, particularly in the city centre. Investors, I suppose, traditionally would not have invested in the office sector in Belfast and Northern Ireland. There's much more of a preference for retail investment, with lots of the retail warehouse schemes being in very strong demand from the institutional buyers. Offices, they have bought some, but it hasn't been that dominant. But I think if you're in a market where you're seeing rents growing by 20%, and there's also potential for yields to come in a little bit further, there's no doubt but that offices will be on the investors' radar over the next 12 months. So moving on to the retail sector, I think it's fair to say that just more so than any other sector of the market over the last few years, retail has really taken a hit. And you'll know yourselves from walking up and down the streets in the shopping centres, it has been particularly challenging for retailers. And I think in Belfast, not helped by a lot of the social and political unrest that you've seen over the last 12 months. But encouragingly, towards the end of last year, there were clear signs of improvement starting to emerge. It obviously depends what area of retail you're in, but many retailers had a good Christmas trading period. Recovery, I suppose, up until now has been firmly focused on the very, very prime high streets and the very best shopping centres, and they're the ones with negligible vacancy, etc. But we would expect to see some of that feel-good factor filtering down into secondary and provincial locations in 2014. I suppose over the last couple of years, while we've been in the midst of austerity, discount retailers have been really the most dominant players in the retail space and have been responsible for the majority of the transactions that we've seen. But we would expect to see that changing and some more high-profile brands coming to the fore over the next 12 months and getting a little bit more confidence. And I suppose buoyed by some of the big lettings that we saw last year, people like Joules, Kiehl's, Mango, setting up new stores. Also quite a lot of activity in the coffee shop and restaurant business. We expect to see some new entrants this year, and we're acting for quite a few of them, including the Apple reseller iConnect, back to the technology discussion again, who are planning to open 2 new stores in Northern Ireland over the course of the next 12 months. There will be other new entrants as well who will follow suit. Already mentioned the growth of restaurants and coffee shops. Even in the last 12 months, there's been a remarkable increase in the volume of restaurants and coffee shops opening. People like Cafe Nero, Costa Coffee, expanding their presence across Northern Ireland, and we would expect to see that continuing. Again, it will follow what's happening in the wider economy. Unlike the office sector, where we're building in significant rental growth of up to 20% in 2014, we're not predicting any rental growth in retail. Retail rents have obviously taken a severe hit. They've flatlined for much of 2013. They're likely to stay quite flat again in 2014. We're not predicting rental growth. Of all of the sectors where technology is going to have an impact, I think you know that technological change is going to have the most significant impact on retail. As we move more and more towards online platforms, new ways of shopping, changing consumer habits, new sales channels, most retailers still need their physical presence, but they might use it in a slightly different way. But they also need an online platform side by side working with that. So the speed of technological change is certainly going to have more of an impact on retail than any other sector of the market going forward, and we need to be very cognizant of that. If you're in a market where the retail sector is still having a difficult time, the need to have asset managers on board, managing your shopping centres, managing your retail outlets, has probably never been more critical than it is right at this point in time. And again, tied back to the point about technological change, you need to be able to incorporate that into your business model. I think if we had to pick one issue which is of most resonance for retailers, it's still the prohibitive rate situation. And unfortunately, there's not going to be anything done about that in 2014 because we're not going to have a revaluation of Northern Ireland properties until next year. So I think for retailers, this is still going to continue to be a very significant issue for them. They've seen their rents rebasing. They've been able to cut their costs in many other ways, but their rates bill has stayed the same, and that's proving a big challenge. Industrial and logistics, this is a sector where there hasn't been a huge amount of occupier activity in this sector over the last number of years. Having said that, we haven't built anything either. So the vacancy rates in this sector are going to continue to decline over the course of 2014. There will be transactions, obviously, but they're mostly going to comprise relatively short-term lettings, usually of fairly low rents, with prime headline rents still only around £3 per square foot. But what we have seen over the last couple of years is lots of owner-occupiers buying buildings, because if they can find a good building in a location where they want to be, 9 times out of 10, the cost of the building is below the replacement cost. And for lots of owner-occupiers, if they have money at their disposal or on their balance sheet, it makes more sense for them to buy the premises than to lease it. So we've seen and will continue to see sales to owner-occupiers as well as some leasing activity. We haven't had speculative development in this sector for many years, and again, we're not forecasting any for 2014. Arguably, if you're only generating £3 per square foot on a rental basis, it won't pay you to go on site and develop a new scheme. So we're not expecting to see that happening for some time yet. We've seen prime rents stabilise, but again, just like in the retail sector, we're not predicting any rental growth in the industrial or logistics sector this year. Now, you might say storage sheds or industrial units, how is technology going to impact there? And it's probably going to have more impact than you might think, because lots of companies are trying to streamline their procedures. They're moving things to an online platform. Processes are changing all of the time to try and speed up production and speed up deliveries. And if you're moving more and more towards online retailing, you have to be able to ship these goods in, store them somewhere, and do the final mile of delivery, as they call it. Another term that we're hearing quite a lot about now is dark stores, which are effectively sheds with not many people working in them, but all robotic, where online orders are fulfilled and deliveries are made. So this is having an impact right across Europe. It's certainly having an impact in the Republic at the minute. We're seeing quite a lot of demand for logistics type units. Maybe Northern Ireland mightn't see the same extent, being that quite a lot of goods are shipped in from Scotland, etc. But it's certainly one to watch. Industrial, again, another sector where investors haven't been hugely dominant. Arguably not a lot of very good quality industrial investment properties have come to the market. Had they come to the market or been released for sale, there would have been strong appetite. It is a sector where investors shy away from, but we would argue if there was good enough logistics property brought to the market for sale, there would be buyers there. Looking at the investment market, we started at the outset looking at the volume of increase in commercial real estate activity on a European basis. We saw it in many other countries. We saw what's happening in the Republic, and obviously on a smaller scale, but the same pattern is being seen in Northern Ireland. So instead of having 8 transactions in the investment sector in 2012, there were 17 in Northern Ireland in the last calendar year, and 15 of those happened in the last 6 months of the year. So what we really saw on the investment side, it was a year of 2 halves. Very little happened in the first half, other than properties were slowly being drip-fed for sale. And then as we went into the second half of last year, transactions started to conclude. And we obviously had a couple of very big ticket deals, things like the Tesco stores in Craigavon and Newry, which we were involved in. A lot of appetite for that. And I suppose looking at the darker green colour on the chart here, what you'll see is 2/3 of that spend was on retail properties. That is unique, because if you look at Europe, if you look at any other country, you tend to have an offices sector dominating, some industrial investment, a little bit of multifamily residential investment, but retail would not be as dominant. And in fact, in the Republic last year, it was less than 5% of spend. And yet 68% of spend in Northern Ireland was retail, because a lot of the big UK institutional type buyers have a preference for retail, and they tend to follow covenants, so they follow people like B&Q, Tesco, etc. The, I suppose, concern a lot of people have at this point in time is supply coming to the market. Is there a danger now that the taps have opened and deleveraging has kicked off in earnest, that you're going to have a flood of assets all being released for sale? And I suppose our expectation is that is not what's going to happen. Even if you look at somebody like NAMA, they will drip feed assets out to the market and feed the appetite that's there on a very controlled basis. So we would think the likelihood of a lot of assets all coming for sale is quite slim. Now there's a lot in this particular chart. It's looking at the yield or the return that you would get. We're looking at what you would have got from Northern Ireland assets at the very, very peak of the market around 2006, 2007, where those yields stood 12 months ago and where those yields stand today. Now, when we put this chart for Dublin up, what we said 12 months ago is completely different today, because yields in all sectors have come in by nearly 100 basis points in the space of 12 months because of the weight of money chasing deals in that market. So Belfast and Northern Ireland is quite unique in that we haven't seen much of a change in yields in the last 12 months, and indeed the 25 and 50 basis point movements we've seen in things like prime retail and prime offices have really only occurred over recent months, as the appetite has started to increase. So what that tells us is there's still lots of opportunity for yields to come in further, and that is encouraging investors. And if we look at our trending line there, you can see that we're expecting that prime retail, prime office, secondary city centre offices will continue to improve from a yield perspective over the next 12 months. One thing that I suppose in a Dublin perspective, if you say yields have come in by 100 basis points, everybody's getting nervous now. Are we suddenly going to be not competitive again if yields keep coming in at that sort of pace? So one thing we do to sense check that is use the data that we can get from CBRE and pitch and see where yields sit relative to other European capitals. And I suppose if you look at Dublin there, you can see where the yield was at the absolute peak, where the yield was when it was the other extreme, and red in the middle, which is where the yield sits today. So what you can see from a Dublin perspective, and this is true of many, many markets, they moved out or almost over-corrected when things were very bad, and they've since started to come back in, and obviously that's good from an investment point of view. If we look at Belfast, not only is it sitting to the far right, meaning it's more attractive than the yields you would get in many other European and UK cities, but yields haven't come back in to the same degree as in other markets. So that would lead you to believe that there's still quite a bit of yield compression that has to happen in Northern Ireland. That's what's encouraging investors. The fact that the economy is slowly showing signs of improvement, that we're factoring rental growth in for 2014, and that there's going to be further yield compression. And I suppose from a Belfast perspective, being that you have a lot of UK institutional type buyers and pension funds and propcos, what you need to be looking at is where does Belfast sit relative to places like Manchester, Birmingham, Glasgow, because these are the cities as those other investors are comparing Belfast to. And at this particular point in time, it looks very attractive from a yield point of view. All they have to do now is find opportunities to invest at those sort of levels. So our expectation is that there's going to be an even higher volume of transactions this year. So just as things started to heat up in the second half of last year, you've started 2014 with that sort of momentum. So we had 159 million of transactions last year, 17 individual transactions. It's going to be higher this year. We have some good visibility on some of the properties that are likely to be offered for sale, including some shopping centres. So even just because of the nature and the size of your typical shopping centre, the volume of spend is likely to be higher. Demand in prime locations in the major cities is likely to continue to come from the UK institutional buyers. There will be local buyers as well, and I think it's important to say that we have noticed an increase in funding availability from banks like Danske, Santander, Barclays and others. So that in itself means that local buyers will start to buy again as well. I suppose for the last couple of years, considering the economic climate that we were in and the property market that we were in, investors have tended to play it safe. So they've focused on very, very safe, income-producing, bond-like buildings. Whereas I think now people are getting a little bit more, moving up the risk curve and taking on a little bit more risk. So we're likely to see people not necessarily focusing everything on prime buildings, looking at something with a bit of a secondary opportunity that will give them an opportunity to enhance their returns. So people will move up the risk curve. They may well start looking at sectors other than retail, looking at things like offices and maybe some specialist sectors like student accommodation, healthcare, etc. As you know, we're factoring further yield compression. We wouldn't be surprised to see another 25 or another 50 basis point move over the next number of months because of the weight of appetite that's there for prime. And I suppose considering the fact that Belfast is still quite a bit away from its long-term average, unlike other cities. And we've already mentioned an expectation that we're going to see more office and industrial type assets being traded. So moving on to the land market, I think it's fair to assume that once you have occupier markets slowly starting to show signs of improvement, once you start to hear some positive news on the housing market, that the demand for land increases. And that was certainly something that we saw towards the end of last year, with quite a lot of activity from things like housing associations and indeed many local buyers starting to assemble sites again. Maybe not necessarily going on site anytime soon to develop them out, but looking at the pricing and buying land now with a view to developing it in the future. So we would expect to see an increased volume of land being traded with NAMA, banks and indeed borrowers themselves bringing sites for sale, driven by improving occupier markets and some improvement in the housing sector, as I said. In some cases, with rents starting to increase again, and considering that the pricing that land is at, development is actually looking feasible again. But as we mentioned, some people will buy and not necessarily start building straight away. Who's going to be selling? It's going to be a combination of the various banks, receivers, borrowers, and indeed NAMA, who will continue to bring sites to the market over the next 12 months. I think when we talk about the demand for prime city centre office sites, obviously there is demand there for good opportunities like that. But what we're seeing is that there actually is demand for provincial land as well, as long as the pricing is right. But the buyers do tend to be local as opposed to non-local buyers. There's not a huge premium available for land in these locations with zoning or planning permission. And I suppose another challenge that we have, and it's something that's very relevant in Dublin as well, is that when you buy land with the benefit of planning permission, in often cases the planning permission is for much higher density usage than what the market is actually demanding at this point in time. So you could well have to go back through the planning process again to try and relax those densities, which made sense at a point in time, but don't make sense in the current market. Moving on, just to touch on the hotel and licensed market, obviously pubs, shops, hotels. The whole region had a very strong year last year on the back of a lot of the big events that were held in Northern Ireland over the course of the year. Now, it seems like a long time ago, but even things like the G8 Summit all happened in the last 12 months. The World Police and Fire Games, which I know benefited Belfast, the Northern Ireland Investment Summit, the Derry City of Culture. All of these things combined meant that Northern Ireland had a strong year, despite some of the civil and social unrest that we saw and the marching and everything else. And I think it's important to say, when you look at the occupancy rate, it did increase year on year. It's important to point out that 5 or 6 new hotels were developed in the Belfast market since 2008. So the figures are even higher again if you factor that into account. So occupancy grew to about 75%. If we look at things like the average room rate in hotels, the revenue generated per room, there was a year-on-year increase in all of those. And I suppose the challenge going forward is, in the absence of a lot of the big events like you had last year, is to try and maintain those sort of levels into 2014. Now, I know you have things like the Giro d'Italia coming, but we don't necessarily have all of the extent of events and that happened in the last 12-month period. Many hotel properties will be traded, and we're aware of some that are due to come to the market over the coming weeks and months, and there is quite a lot of appetite there, both for existing trading hotels and equally for well-located buildings that could ultimately be converted to hotels. And obviously we sold last year the Scottish Mutual building in Donegal Square, which was sold to a hotel operator. So there is actually demand as long as the property is well located. We had quite a lot of pubs changing hands last year. It's our expectation that there probably won't be the same volume of activity in that particular sector, but who are we to know whether any of the big UK multiples might come in and take a chain out or something over the course of 2014. But in terms of individual pub properties being released for sale, we're not expecting a huge amount of that. We mentioned lots of hotel operators looking for good opportunities, and there is, I suppose, encouragement that there's further improvement in room rates, occupancy and RevPAR anticipated. And that is a big challenge, because I think one of the big issues for hoteliers is that at current room rates and the sort of income that they're generating, many of the hotels are trading well, but they're not necessarily profitable. And obviously that has implications for valuation as well. So it's something to be mindful of. So to summarise all of that, I think 2013 will probably go down as a major turning point for the Northern Ireland market. In my view, it's at least 12 to 18 months behind what the sort of activity we're seeing in the Dublin market. And I think a big challenge is not having a decision on the corporate tax rate, because without that, you're not going to see the same volumes of foreign direct investment, and you're unlikely to see any major announcements being made. 2014 in our mind is shaping up to be an even busier year than the one just gone. We mentioned 2013 being a year of two halves. If we can have 2014 being the same as the last half of 2013, it certainly will be a stronger year. In terms of deleveraging, obviously there's still a lot of deleveraging that has to happen from all of the various banks, from NAMA and indeed borrowers themselves. But we would expect the pace of supply to come on at a similar pace as the last 6 months. A lot of the UK institutions are still firmly focused on Belfast, and if you think back to the slide that I showed you, where the yields or the cap rates sit relative to what you would get in any other competing cities across GB, you can understand why that is the case. And I suppose the challenge for a lot of these institutions is to try to find the sort of prime product that they're looking for. We're expecting some yield compression, so that in turn is driving investor demand. We're expecting further new office development and a lot more discussion around refurbishment, and we would, I suppose, also expect to see planning being lodged on quite a few new schemes, particularly in the city centre, where Grade A shortages are going to continue to persist in the short term. We are, I suppose, being quite bullish in that we're expecting to see 20% uplift in rents, up to about £15 per square foot in the office sector, but no rental growth, as we said, in the industrial or retail sectors. And finally then, just to touch on technological change again, I know you're going to be sick listening to this, but we really can't emphasise enough to the extent to which this is affecting us on a day-to-day basis. We have to try and look ahead and preempt how much office space we're going to need, how much retail accommodation we're going to need, what these buildings are going to look like, and try and preempt the sort of real estate that we will need in the future based on how quick technology is changing. In the office sector, we're increasingly moving towards remote working and hot desking, and indeed in our own office in Dublin, we are introducing a hot desk zone where you'll wheel your computer in and plug in wherever you can find a desk. So we're embracing that technology ourselves. We're moving more and more towards remote working and a different way of working. In the retail sector, it's the move towards online that's really having a huge impact. And logistics, obviously, huge impact there in terms of the storage and the physical movement of goods. So technology in some shape or form is going to impact real estate in terms of how it's planned, how it's designed, how it's developed, how it's occupied, how it's owned, and how it's managed. So it's something we as an organisation are going to invest quite a bit of time and energy and money, obviously, as well, into being, I suppose, looking ahead and trying to preempt how this is going to shape real estate going forward and how it's going to affect the market for everybody in this room. To finish with some words, we mentioned all the words that are affecting us in terms of doing our job today. These are the words that we feel are going to affect us over the next decade. So things like 3D printing, is that going to reduce the need for storage of goods if you can actually print something yourself? Digital walls, computing, drones delivering your goods. All of these seem fanciful, but the way technology is changing, these are the things that are going to be shaping our market over the next number of years. And if we could pick two that are going to have the most impact, it is globalisation and technological change. Thank you.